for checking out the Mark Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Awesome, awesome. You want to start with the disclaimer?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to help, to give you advice, provide you with guidance. There's a disclaimer.
All right. What's going on in the pre-market today?
Yep, let me share my screen. And before we get started with that, Will, if anybody out there is new to the show and you have questions, you could put those questions on the live chat on YouTube. Will's watching them, he'll read it back to me. If you want to come on the show and ask your questions directly, we also put out a link to Zoom. Click on that link, it takes you over to Zoom. When you get to Zoom, click on the button, raise your hand. Then you'll be able to ask your question directly. You don't need to turn on your video camera. So those are two ways to ask questions. While we're waiting for any questions to show up, I'm going to take a look at the pre-market report, see what's trading in pre-market hours. And then I think we'll discuss a little bit about, we'll talk about valuation models and maybe forecasting models, because I think there's still confusion between the two, just based on some email questions that I get. And we'll talk about why they're important. Why do you even have to pay attention to them? So we'll have just a discussion on that. If you guys have any questions on that, put those in that live chat, and we'll try to answer them today.
Perfect.
So let's get started. Yeah, let's get started with the pre-market report. And these are stocks trading in the pre-market hours. We have our most active stocks, our biggest percentage gainers, biggest percentage decliners. Down here, I see 151 stocks made our percentage gainers list, 34 in the percentage decliners. So right now, from that perspective, looks like we're setting up for more bullish bias at the open. I'm going to filter out this list and filter them down to just S&P 500 stocks. So this will take out any low cap stocks, preferred stocks, ETFs, closed-end funds, leverage products, warrants, all that. Let's take all those out just to see what's going on in S&P 500 stocks. And I'm going to use the filters above to do this. So here's a filter in ETF. And by dropping it down, I could select one of the ETFs in this list. SPY is the S&P 500 ETF. So by selecting that, this list will get filtered by SPY holdings, which are the constituents in the S&P 500. And here we see 18 stocks made our percentage gainers list, one on the decliners. So again, from that perspective, we're setting up for more bullish bias at the open. So that's the pre-market. I guess, if there are no questions coming up, I'll start kind of discussing the valuation models.
Yep, no questions yet.
All right. And while we're on it, we do have a webinar tomorrow, right? Let's just mention with interactive brokers. We're going to, it's going to be what time, Will? At 2
It's 2 p.m. Tomorrow afternoon.
Okay, and it's going to be debit put spreads. So we're going to discuss debit put spreads, do a couple screens. So that's going to be tomorrow, 2 p.m. And for that, you have to register with Interactive Brokers. That's something they're hosting, so it will not be on YouTube.
And I'll put that link in the YouTube chat so everyone can register if they want to. Perfect.
Okay. And let's get to maybe valuation models. And a lot of times what you'll see that we're big on is, these trade idea cards are basically using a valuation model to come up with a theoretical value to compare to a market price. And valuation models, it's not a prediction. It's not a prediction or forecast what's going to happen in the future, right? I think some people, that's maybe they're confused, but a valuation model is really trying to assess, given the information out there, what do we think a fair value of a security is? And you could come up with valuation models for lots of things, come up with valuation models for a car, come up, for used furniture, so there's ways to model and try to come up with a value for stuff. And that's what we do also, stocks, securities, and that's in options. So think of valuation models like this. Banks have valuation models for everything they deal with. And when a bank gives you a loan or a mortgage, one of the things they do is they send out an appraiser and say, take a look at this house, appraise it, and tell me what I think it's worth. And the appraiser doesn't create a forecast what they think the house will be worth in 2 years or 5 years or 10 years, right? That's not what they do. They come in there and say, well, based on these different factors, we think that the price of this house is approximately this much, right? And it's a valuation model. You can't come up with an exact to the penny, right? But you're coming up with, based on these factors, they could look at recent sales, they could look at, how much it costs to build this or replace it. Whatever they do, they come up with a value, they give it to the bank, and then the bank will make a decision. That's one of the factors that the bank takes into consideration besides your credit score and stuff, how much they're going to lend you and if they're willing to lend to you. And since we've been trading value, everybody from the professional side will use a valuation model. And the better your valuation models, the more, the better you do, really. But, it doesn't matter if you're Susquehanna, Citadel, all of them are running valuation models. And I'll give you some examples, because sometimes I hear this, like, well, do you ever hear, well, there's no point looking at information or fundamentals or whatever, because whatever the stock price is, it's already reflected all the information out there. So whatever it is, the stock price is already reflected that. Do you hear that a lot?
You do hear that a lot.
So what is the message telling you? That there's no point in doing any research because there's no alpha in it. That means any research you do or anybody else does. It doesn't matter if you're a bank or a trader, doesn't matter who you are, it's a complete waste of money and energy and time, which would mean that nobody should be doing any research, because that would just be a wasted cost. When that isn't that the logical conclusion? Well,
yeah, it would mean Warren Buffett should have stayed in the actuarial business, I think, rather than
that would mean, that every person who goes to college for finance, that was a waste of money. Every person who sits in JP Morgan is just it's a useless job. That would be the logical conclusion, because there's absolutely no alpha, there's no benefit, there's no profit potential for anybody to do any type of research on a stock. And that's kind of, sadly, that's what's being sold to a lot of people. And especially, it's appealing to lazy people, that, why would I even do that? Why would I look it in? Because other people are looking at it. It's all reflected. There's no opportunity to do any type of research. And what we call that in the professional field is the uninformed trader. The uninformed trader basically puts in orders without doing any type of really useful research, and they're going to send it through their broker. And then on the other side, guess what happens? People are actually, who's buying? So those orders are actually being purchased for the right to trade against them. So think of it this way: those orders that are being inputted through the broker are the uninformed orders are so valuable that people are paying the broker just say, let me send it to me so I could trade against those orders on the other side. And they'll pick and choose, but the people who are trading against them are running valuation models, right? That's because they know which ones to trade against, which ones not to. And they know that the other side has done no research at all and they're uninformed. And I'll give you some examples, when we talk about why we run, before we get more into it, I'll give you a simple example. Some valuation models are not exact. You can't get an exact value. It's a model, where you're trying to get an approximation, like where do I think it's worth and how far away is it from my benchmark? But sometimes you could get even an exact value. And this happened when the ETFs first came out. And the ETFs, when they first started trading, most people just took that position where it doesn't matter, the price is the price. And the price does reflect the supply and demand, right? So there could be a lot of demand to buy it or a lot of supply to sell it, right? So the price will reflect that. But like Warren Buffett says, price is what you pay, value is what you get. And what happened was that the ETFs, there were a handful of people, trading against, thousands of others. And what they did was they just simply said, okay, well, if I could take the holdings in these ETFs, all right, here we go. I know which stocks the ETF has. I know the holdings, what percentage. I know what price each stock is. I could create the NAV, net asset value, and compare it to the stock price. And the two were very divergent, right? You had it when it went way above net asset value, way below, and there were ways to hedge it, right? In the beginning, the divergence was so big, I think people just kind of did an arm, just bought the entire basket of stocks, right? Or sold the entire against the NAV, and then they would redeem them, create them, and so forth. Then they found other ways to hedge them, futures and so forth. But that's a simple model that, shockingly, most people ignored and just kind of traded the price. And I'll give you another recent example. Here's one you guys could look up. Who owns the FTX? FTX is Sam Bankman-Fried, right? You guys probably heard of him. He's big into crypto. He came from also market making side. I think he worked for Jane Street, I believe, trading ETFs. And
was it Jane Street?
It was.
Yeah.
So you guys could look him up. He's now all over the news. I think he's in his 20s, worth $10 billion. And that's what he worked on, right? Valuation. You could go watch videos. I think he even talks about how he worked in Jane Street trying to price ETFs and said, well, how do I price this ETF? Because some ETFs are harder to price because they got, assets in there that are the prices, the values are non-observable, meaning they're not trading somewhere. So when he made his billions of dollars, he looked at the Bitcoin and did something very simple and said, well, all right, here's the value, here's the Bitcoin, here's the price here in America. And then he looked overseas and said, well, overseas, the price is 20%, 30% higher. You had to just do the conversion in dollars to yen or whatever I forget which country he started doing this arm. And simply put, he's like, if I buy it here, transfer it over there, sell it in that currency, convert the currency back to dollars, there's a riskless or almost risk 20% spread, right? 20% premium over their parity. But again, if you're just looking at prices, you wouldn't have figured that out. You'd have to go in there and figure out the difference between, well, here's it in this currency, here's this, and you got to figure out how to move. Again, this is an arbitrage. Usually you don't have an arbitrage situation. And I don't know if that was exactly an arbitrage because I don't think you could have done it simultaneously. So you had to first own it, move it over, sell it. But there's a big
spread. Probably a lot of the risk was in transporting it, right? You had to rely on a person with a zip drive or something. Getting on
it. So there was it wasn't so that was not an arbitrage because it wasn't a simultaneous buy sell click of a button.
Well, it was an arbitrage, but it wasn't simultaneous. You're right. There was a time premium in the risk of converting it. Yeah, it probably took days, right?
Yeah, the banks had to let you do it. So I think he had like a team of people, flying over with their drives to, I think he was buying it on Coinbase. I believe he was buying the where the retail traders right hanging. So I think he was buying the Bitcoins on Coinbase. I think, I'm not positive, but I think.
Yeah, and actually he was doing it. The way he wasn't with Jane Street when he was doing this, right? He figured out this existed, and he went out and either raised some capital or used his own capital for the first trade, right? And then did it again. Right. I think he started. It's an amazing story. He started off like taking commercial airliners right over to do it, right, himself, and he was able to do it, and so super interesting story.
Super interesting, but the point that I wanted to make is that it was only possible because you could run a model and see, clearly, and it's not in the price. It's like you have to see it in the value, like you have to see it completely in conversion. This and this should be equal, but they're not, right? And this is how far apart they are. And is it worth taking the risk? So it has to come from, the ability to see beyond just a moving stock ticker, beyond the moving price, right? And I get that, and I'm mentioning this, because there's, I get people, a lot of people are like, do think that, what's the point in looking any deeper, that the price is reflected of, all the information. And the price is reflected of all the different people. And there's a bunch of different people reading different things. And based on whatever they're reading or whatever they're looking at, they're entering orders. And it's reflective of the supply and demand at that point, right? But they're not all reading the same thing. And they're not all looking, interpreting, and they're not all getting, exactly the same information and interpreting it all exactly the same way. There's divergence of opinions, and a lot of them, and a lot of times the market could move very far away, one way or the other, from some kind of a reasonable benchmark or valuation. That's why we work hard on trying to create a valuation. Think of it like, the real estate market and the disarray would be if there was no appraisers and, there wasn't, things would be all over the place, right? They would trade in much more erratically and much further away from reasonable prices.
Mike McCrae is asking, do you know how long that ARB lasted for the Bitcoin?
So, I don't know. I want to say maybe they were doing it for a couple months, maybe 4, 5, 6 months. It didn't, I don't think it, I don't know exactly. He discusses it freely, in interviews. So you could go back and look how long he did it for. But, it wasn't like years or anything, but it's the ability, right, to, when you're used to running models, valuation models, and then you start finding these things. You start knowing how to seek it out because it makes much more sense, not just from the price perspective, but where, hey, these prices are much further apart, and there are ways sometimes to hedge them or ways to, get related products to hold on to positions. But usually, what you see in trading is hedges, right? Like spreads. You're spreading off risk, and when you're buying something, you're selling something, you're spreading your risk around or hedging away some of your risk. You can do that in options, even in stocks, ETFs and so forth. So knowing, you got your valuation models and knowing all the kind of different assets out there. I want to say though that it may have lasted for like 6 months. That are, and that's why they're able to make so much, because they started, like any model, you start out small, and when it works, you start increasing it. If it works, you start increasing it. But I believe that's how they did it over a 6-month period. Which, by the way, that wasn't the only ARB they were running. That was just a very massive one where they made a lot. But I think they're probably still doing it as a trader. He's still trading, I believe, and his team was looking for those types of opportunities in other places, in other cryptos, and I believe they started out in the ETFs. So again, the valuation models become so, and that one is an example of maybe an exact price. You could get an exact price because it's basically, these things should equal out. If you buy and sell it, they should equal out. But not all models are like that. You can't get an exact price for a company, right? And it's hard to get an exact price for even an option unless you're looking at the intrinsic value. So when we look at an option, right, let's say here in SPY, we know that here's a SPY closed at $413.47. So we know the 410 strike, right? If the call itself should be worth at least $3.47, because if anything below that, it would be below parity, right? So if I could buy a 410 call for $2, well, I would do that because I could then sell short the stock for $413.47. The call that I bought for $2, I could exercise. So that's like equivalent to buying the stock at $412 and selling it for $413.47, right? So that would be an arbitrage opportunity because it would be below parity, right? And that would be a simple ARB. My valuation model would tell me that, and I would start ARBing away. So we know it has an intrinsic value based on the difference between the strike price and stock price. But options also have premiums, and that's where it becomes subjective. How much more premium do you give that option above parity? We call that the time premium, and those are the things that the market starts to price in based on different probabilities of things happening. And there are different models. There's no one right model or one model that everybody sticks to. Just like, you could even if you have like 3 different appraisers appraise a house, they're not going to come up with exactly the same price to the penny, right? They might come up with similar ones, but different people might even come up with different ways of measuring it. Some people might say, I'm gonna value this house based on the rent that I'm able to collect, right? So if I could collect $10,000 in rent a year and I require 10% cap rate, that means this is worth $100,000 to me, right? And I don't care I don't care about the last sales wherever they are. That's what it's worth to me. Other people might look at the last sales. Other people might look at how much would it cost me to replace this house and build a new one. And all those could be, it's different ways of looking at it, different models, and you're going to come up with different answers. So when you can price it like that exact, right? Like I could give you a parity, right? The parity I know exactly because I could compare the stock price, the strike price, and the difference. But the time premium and the volatility and all that, there's no way to do it exactly. You have to then use a model to create assumptions. But if you have reasonable assumptions, then you could start comparing those prices versus your model, and you could start tweaking your model, right? You could say, okay, maybe I'm a little bit too low. I didn't consider this, volatility might be higher because of this and this and this. But that's what your model lets you do to see where you are versus the rest of the market, and do you agree with it, disagree with it, and why is the market very high or very low. So it's also important to understand that too. So once you run your valuation model and you see, well, the markets are, let's say, very, very high based on my valuation model. So why is that happening? What's the reason behind it? Because there could be a good reason, right? And it could be, maybe, there's a war going on, or, with a lot of uncertainty. Maybe the markets are afraid, inflation numbers are going to come out, and if they're bad, we're going down, whatever it is, you have to figure it out why it's doing it, because that's another important factor. So you got your benchmark, and then to understand why is it far away from your benchmark. So and just like Sam did, he figured out, okay, there's an arc between these two geographical areas. Figured out, well, why is it happening? Well, it wasn't easy. It wasn't easy for people in Japan to buy, on the platform in America, and it wasn't easy for people in America on the same platform to do it in Japan. There's no connection there, right? And there's no way to do it through banks. There's no way to do it electronically. It had to be done physically, right? So that's where he figured out that the reason there's such a high spread, he understood, was because there's no way for anybody to close that spread unless you physically had to go buy the Bitcoin and put it into a wallet, fly out there with your wallet, and then sell that Bitcoin, on the other exchange, take the currency that you sold it in, go to a bank, explain to the bank where you got this money, then the bank had to go through their money laundering, accept your reasoning. You had to get the account, they had to accept what you're doing as legal, and then you had to go through the bank and transfer back that to the United States bank, and they had to accept your explanation and your reasoning, and you had to do all that within the legal framework, in millions of dollars or tens of millions or whatever they were doing. And that's what he saw, was there was a discrepancy. He understood why it existed. That's the important thing. Why does it exist? Because it could be for a good reason, and it should be that way. So you have to understand why it exists and how to, exploit or profit from. So really quick, just wanted to kind of cover why we start looking at valuation models, and they become key. Anybody in the long term who is successful in the field of financing will run valuation models, have their own valuation models, know how to tweak them and use them. So we're right up at 9:30. Well, I guess no other questions. I'm going to leave it there.
No other questions. Lots of kind words today. Actually, Vlad said, what's he say? He said, MC equals best morning show, which is always much appreciated. And it doesn't work. I typed it in, but it doesn't work without the crew who shows up every day and keeps us going. Thank you, everyone. Dima, great job. You always bring it, which is greatly appreciated by the entire community. You have a great day, my friend.
Thanks, everyone. Stay safe out there and have a great trading day, and hope to see you guys tomorrow.
Trade in peace, Chameleon.